Well, throughout this lecture we are going to be discussing reversal patterns. Reversal patterns are the price patterns which we utilize to confirm that price is indeed beginning to change from sell to buy program or from buy to sell program. It's very important to note that these reversal patterns by themselves mean absolutely nothing. Meaning I don't want you to go into the charts and simply look for these reversal patterns to be there and trade based upon them. No, hence why I'm creating this lecture and releasing it for you after all the other lectures have already been released to you. Because it's important to understand that there's a particular sequence through which we look at the markets. We first pay attention to liquidity through the lens of time cycles, then we utilize intermarket relationship, and then we utilize reversal patterns to anticipate, alright, now we are indeed beginning to reverse from sell program to buy program and from buy program to sell program. But if you do not understand how to utilize liquidity accordingly yet in order to anticipate where the market is going to draw towards, or how to utilize the time cycles to anticipate when the market is going to move, this lecture is not for you yet. But if you are at the stage now where you have a good grasp of how to utilize liquidity and time cycles, then please continue watching this lecture. So with that being said, we're going to be diving into a few reversal patterns, which I'm going to be outlining to you, which you can start investigating within the charts, and this is going to be crucial before you watch all the trade breakdowns, all the uncensored episodes, and all the live streams which take place. So with that being said, let us dive into today's lecture. When it comes to reversal patterns, the first reversal pattern which we're going to be paying attention to is the following. What I want you to see is that when we pay attention to this reversal pattern, we can see that the market took out this high right here. But I want you to understand that the reason why this high in particular is so important is due to the following. We form a high, retrace, and notice that this low right here forms and it sets up one more push towards the upside. One more repricing higher. As this run higher is taking place, what I want you to understand is that retail is being trapped into believing that we're going to be breaking out above that high. Instead, however, we see a rejection taking place. We see the market actually form a higher high relative to the previous high, and the market begins to slam towards the downside. Do you see how the market displaces lower with a lot of speed and velocity? Notice that the market displaces below the low right here, which set up that final push towards the upside. And the reason why this is significant and why we pay attention to this is due to the following. What I want you to understand is that in order for order flow to remain bullish and for the market to continue being repriced towards the upside, down close candles should function as support on price when we make higher highs. Instead, we see the market displace below the low, which set up this final push towards the upside. Hence why this final down close candle becomes a bearish breaker block right here. We take this full candle and we extend it to the right. And what we pay attention to is the moment that price displaces below that low, if that candle is going to function as resistance on price. And one thing which is very important to note is that when it comes to this breaker block in particular, there's something key which I want you to understand, and that's the following. This price pattern right here, where we see the market have these three down close candles right here, what I want you to see is that when we pay attention to these three down close candles, what you will notice is that between candle 1's low and candle 3's high, there's a gap, meaning there's a lack of specific delivery. What delivery? Buy side delivery. Hence why the range between candle 1's low right here and candle 3's high becomes what? It becomes a bearish fair value gap, a CB. What we are looking for is looking for that CB to form as the market is displacing below this down close candle. And the reason why this is so significant is because what I want you to understand is that the moment that the market retraces into that area, we're likely going to see the market form a high and begin repricing towards the downside. This algorithmic signature of a bearish breaker forming paired with a CB is one of the most important algorithmic signatures when it comes to recognizing bearish market reversals. So it's very important that you engrave this within your mind. Now, when it comes to this price pattern in particular, we only pay attention to it the moment that we see key time-based liquidity being taken out and that we see intermarket relationships suggesting that we're likely forming a swing high. From that moment in time, we begin to pay attention to this bearish breaker formation. Now when we pay attention to the opposing scenario then, in bullish delivery, in bullish market reversals, the delivery looks exactly the same but inversed. What I want you to understand is that when we pay attention to this delivery, what you see is that an initial low forms right here. Notice that I've outlined the low of this candle and I've extended it to the right. We see the market retrace and a high forms. The market has one more push towards the downside and we make a lower low relative to this low right here. And the reason why that is so significant is because we take out the sell side liquidity resting below that low. Now, what I want you to understand is that the moment that low gets taken out, and we see the market begin to run towards the upside very quickly with a lot of speed and velocity, our eye is drawn towards the final up-close candle which formed before we saw this push towards the downside taking place. Meaning our eye is drawn towards the up-close candle outlined in gray. What we pay attention to is the following. We pay attention to whether or not we're going to reprice above that particular range. If we reprice above the range of that up-close candle and we see the market close above that and preferably also the high which might form next to it, in this case this high right here, we anticipate that this up-close candle will function as support of price. Because for the underlying order flow to remain bullish, it has to. And the one thing which I want you to understand is the following. The pattern which I outlined to you of a bearish value gap within the previous slide can now be seen but that on the bullish side. Because when we pay attention to these candles right here, we have this down close candle and these two up close candles which follow afterwards, what I want you to see is that we see a lack of sell side delivery between candle 1's high and candle 3's low. That means that what we can outline is the range between this candle and this candle right here. Why? Because there's a lack of sell side delivery in this range. But it's very important to understand that within my example right here, you can see that price does not retrace into that range before expanding towards the upside. And you might be thinking to yourself, Frank, why does that happen? Why does the market reprice higher without actually retracing into that imbalance which got created? One of the most important things which I want you to understand is the following. Within very quick reversals, where we see the market really begin to speed up, we can anticipate that there will be instances in which the market might not retrace into the imbalance which gets created. Hence why paying attention to the final up close candle or the final down close candle within a bearish reversal is very important. Why? Because the market can already find support there and they continue expanding towards the upside. And I want to give you a little hint. I want to give you a little tip, something you can look for when it comes to intermarket relationship. When you have one market which is higher correlated to other markets, make this imbalance, and you recognize on the other markets that this imbalance is also forming, what I want you to investigate is whether or not the other markets are retracing into that imbalance which got created, whilst the market that you're looking at might not. The moment that you recognize that taking place, you do not have to wait for the market to trade into that imbalance to potentially enter. The reason why is because the market is likely going to do what? It's likely going to begin running towards the upside. The most important thing for you to recognize is that what I'm outlining to you is that when it comes to the formation of this breaker, the moment that this breaker forms and the moment we see the market begin to displace above the high right here of this final up close candle, from that moment in time we can begin paying attention to, is price now changing from sell program to buy program? But only when we know that this right here is in fact the swing low formation which we were anticipating to likely take place. Meaning we pay attention to the time cycles and liquidity, of course. Now when it comes to breakers, you must understand that there can also be instances in which there's no lower low which forms. Meaning when we pay attention to this delivery right here, what I want you to see is that instead of a lower low forming to the initial low which formed, we actually see a higher low form right here. And the importance of that higher low formation is the following. What I want you to understand is that what I'm outlining to you here is that if one market makes a lower low whilst the other market makes a higher low, you know by now that that right there is a bullish SMT. That is a bullish Kraken correlation which is in play. So when it comes to that bullish Kraken correlation which is in play, we pay attention still to the final up close candle which set up that drop towards the downside, and we extend that candle to the right. That candle becomes a mitigation block, a bullish mitigation block. We pay attention to whether or not the market is going to displace with speed and velocity above that particular candle. When the market does displace above this candle, what you will see is that the market will retrace into that range, and we then can anticipate that that is likely going to function as support and price. Now it's crucial to understand that when it comes to the movement above this high, we ideally want to see a imbalanced form, a BC form, a bullish fair value gap form, as the market is repricing higher, as you can see. Now what I want to ask you is, are you able to recognize the imbalance by yourself now? So pause the lecture for a moment if you're having a hard time with seeing it. Because this gap right here, which gets presented between these three upclose candles right here, what I want you to see is that what we can outline very clearly is this lack of sell side delivery between candle 1's high right here and candle 3's low. Do you see how candle 2 just expanded towards the upside and how the market did not retrace into that range of candle 1's high? That means that there's a lack of sell side delivery within that particular range, meaning the market is likely going to retrace back into that imbalance, into this upclose candle right here, to continue expanding towards the upside. Now when it comes to what I outlined to you with regards to intermarket relationship, if you see this imbalance forming on the market that you're looking at and on the correlated markets which you're paying attention to, if one of the markets does not trade into the imbalance whilst the other market does, then that right there is a crank correlation which is important to monitor. Now when it comes to where to position ourselves potentially, you're going to be learning that more in depth throughout the trade breakdowns and throughout the uncensored episodes, where you see exactly in real time the application of this logic. All that I'm outlining to you now is recognizing reversals, because when you become good at recognizing the beginning of a new price swing, the beginning of a movement from A to B, that right there is the most important thing to recognize. Finding the right entry, defining the right invalidation level, etc. That all comes in due time when you get more experience and you begin to see how far price actually retraces and how far it's allowed to retrace. As a general rule of thumb, price should not displace below the final upclose candle right here, in both the breaker as the mitigation block. Now when we pay attention to the bearish example then, what I want you to understand is that when we pay attention to this high formation right here, what I want you to see is that the market made a high, we saw the market reprice lower, see the market have one more push towards the upside, and notice that the market actually makes a lower high relative to this high right here. The moment that the market displaces below the final downclose candle, which set up this final push higher, that downclose candle becomes what? It becomes a bearish mitigation block. So whenever there's an SMT present on the highs right here, which is setting up a market reversal, I want you to understand that on one market there will be the creation of a bearish breaker, whilst on the other market there will be the creation of a bearish mitigation block. The moment that we see the market reprice below this downclose candle, we can extend it to the right, and we must see that downclose candle function as resistance on price. Now again, it's very important to understand that there has to be the creation of a CB throughout this repricing lower. Now I want you to think about something. Why oh why is the creation of an imbalance so important? Try and outline for yourself what the answer to that question could be. Is it simply, oh, we see an imbalance form and therefore it's important? Or is there actually more behind the price pattern of an imbalance forming? Think about it for a moment. I want you to understand that what an imbalance actually showcases to you is that there is a sense of urgency. There's a sense of price is repricing with a lot of speed and velocity now. Hence why it's so important to look for that algorithmic signature. Because the moment that algorithmic signature is present, it signals to us, yes, we have formed a swing high, the time is right now for the market to begin repricing towards the opposing side of liquidity. We took out buy side liquidity, now we're likely going to draw towards sell side liquidity. But remember, it's not just the price pattern. It's not just, oh, we see an imbalance form, therefore we must roll over. Oh, we see a break or a mitigation block form, therefore we must roll over. No, it comes back to understanding that the time is right for the market to begin changing from buy to sell program. but the CB, the bearish value gap, can be seen between this candle right here and candle 3's high. Notice that between candle 1's low and candle 3's high, there's a lack of buy side delivery. The market does not reprice all the way back towards candle 1's low. Now it's important to understand that you might be thinking to yourself, why, Frank, within your examples does the market not fully trade into the gap? The reason why is due to the following. What I want you to understand is that whenever we see the market form a swing high or a swing low within a bullish reversal, and we see this price pattern unfold of either a breaker formation or mitigation block formation paired with an imbalance, we don't want to see the market trade all the way into the lower end of that bullish imbalance or into the higher end of that bearish imbalance. It's possible, so our stop loss must allow for it, but for the quickest delivery, we need to see the market tap into it and then go, and then it begins to tank. But again, inter-market relationship has to be investigated relative to the creation of this particular imbalance. And what you will notice is that over time, you're going to see again and again that there's likely going to be a current correlation forming within that particular imbalance. And I'll let you think about why that's happening. And one thing which is important to outline as well is that every single price pattern which I'm showcasing to you throughout this lecture is actually fractal, meaning it occurs across all time frames, from the bigger time frames all the way down to the smaller time frames. So that's something worth investigating, isn't it? Because do you recognize that if you're seeing a swing high form on, for example, a 5-minute chart, on a 1-minute chart, that within a seconds chart, that same reversal pattern is likely going to be there, but way sooner? That's worth investigating, isn't it? Man, oh man, the golden gems, huh? Now, when it comes to another reversal pattern, which I want you to start paying attention to, is the following. What I want you to see is that right here on the left side of this delivery, I have outlined the creation of this bearish value gap, this CB. Do you see how there's a lack of buy side delivery between candle 1's low right here and candle 3's high? The market just rips lower. That means that between those two candles, there's something happening. And what's happening is that the gap is being created, meaning a bearish value gap gets created. But as the market is showcasing to us that a swing low is in the making, there's actually something very interesting which we can anticipate to take place when it comes to that gap. Instead of that gap being utilized for resistance purposes to continue expanding lower, we can anticipate that that gap is likely going to be utilized as support and price to do what? To continue repricing towards the upside. Now, one thing which I want you to understand is that whenever you see a bullish value gap form as the market expands above the range of that bearish value gap, you have a bearish value gap paired with a bullish value gap, which is showcasing to you urgency. It's showcasing to you we quickly drop towards the downside, we quickly start price expand lower, trapping everyone into believing lower prices are next, and now we all of a sudden see the market begin displacing above that range, which should have functioned as resistance from price in order for the order flow to remain bearish. The fact that we didn't is signaling to us, wait a minute, something is happening here. Hence why the moment we displace with a closure and speed above this CB's range, we're going to be monitoring if that CB is going to function as support on price. And this can actually happen before a breaker formation takes place, or before a mitigation block formation takes place. Interesting, isn't it? Because when you realize that and you begin to investigate that, you begin to become able to anticipate when that breaker and mitigation block is likely going to form. Now, when it comes to what this looks like within a bearish reversal, what I want you to see is that on the left right here, we see the market quickly expand towards the upside. We see it quickly run higher. Do you notice how between these three candles right here, and specifically between candle 1 and between candle 3 right here, we see a lack of what? A lack of sell side delivery, because candle 2 just expands towards the upside, as you can see right here. The range between those two candles, between candle 1, it's high, and candle 3 is low, is what we refer to as a bullish value gap. The moment that we see the market displace below that imbalance, and we see it actually begin to close below it right here, from that moment in time, we can anticipate, well, wait a minute, we should have bounced there to continue higher. We don't, so hence why this gap can now actually be utilized as an inversion value gap. It can be utilized to do what? For the market to retrace into it and continue expanding lower. So do you understand that what we can actually do is we can extend these imbalances to the right? When we see this formation taking place, near swing high formation, we can anticipate that the bearish breaker or bearish mitigation block is likely going to be made next. So it's very important to understand that these fractals are always present. Our job, however, is to only pay attention to them when we recognize that the swing point is in the making. That right there is the main takeaway which I want you to have from this lecture. Because as you are going to study all the trade breakdowns and all the uncensored episodes, and you're going to attend all the live streams which take place, you're going to see a repeating phenomena. You're going to see the repeating phenomena of us focusing on recognizing a swing formation, and the moment that we recognize that swing formation in fact being in play, from that moment in time we can anticipate now we're going to be looking for these algorithmic signatures, these price patterns to present themselves within the charts. So with that being said, these are the major reversal patterns which I want you to investigate. Later down the line, you're going to be learning more key patterns, you're going to be recognizing more key algorithmic signatures. And when I say pattern, I don't mean a price pattern that you simply just trade based upon because it's there. No, I'm outlining to you simply a sequence of events. And this sequence of events gets confirmed by price showcasing this price pattern. And I hope that that is a major light bulb moment for you. Thank you for watching this lecture all the way to the end. I want to wish you a lot of good luck with investigating for your own charts these reversal patterns, because I promise to you, you're going to see them in every single key market reversal that takes place. And from that moment in time, your eyes begin to open, because you're going to see how time and price align, and how when the time is right, all of these algorithmic signatures take place. Good luck in your studies.